Something unprecedented just happened in the copper market. And if you are not paying attention right now, you are going to miss the clearest signal the commodity markets have sent in years. Within the last few hours, the London Metal Exchange witnessed a spike so violent, so historically rare, that traders who have been in this market for 3 decades stopped what they were doing and stared at their screens in disbelief. The COMEX spread on copper contracts briefly exploded to a $100 per ton premium. Let that sink in for a moment. $100 in a single-day spread. That is not a typo. That is not a drill. That is the sound of a market screaming that something is fundamentally broken in the global supply chain. And the implications for your portfolio, your retirement planning, and your understanding of commodity markets are about to become crystal clear. This is not just a story about copper. This is a story about the intersection of geopolitical chaos, fiscal policy meltdown, and the quiet desperation of a global economy that has suddenly realized it cannot find the metal it needs to power the artificial intelligence revolution. And by the time we are done here, you are going to understand exactly why this matters, what it means for silver and other industrial metals, and how the decisions being made right now at the World Economic Forum in Davos are sending shockwaves through every asset class you care about. Let me take you inside what happened in London today. The COMEX spread is a technical term that most investors never think about, but right now, it is the single most important number in global commodity markets. It represents the price difference between copper contracts expiring tomorrow and those expiring just 1 day later. Normally, this spread is measured in pennies, maybe a few dollars at most. It is supposed to be boring. It is supposed to be a rounding error. But today, it spiked to $100 per ton, and that number has not been seen since the great copper squeeze of 2021 that forced the London Metal Exchange to implement emergency rule changes to prevent a market meltdown. The reason this matters is simple. When the spread between today's copper and tomorrow's copper explodes like this, it means one thing: physical metal is vanishing. Traders who need to deliver copper to fulfill their contracts are discovering that the copper simply is not there. They are willing to pay almost any premium to get their hands on the actual metal right now, because the alternative is defaulting on their obligations. And when you see this kind of desperation in one of the most liquid commodity markets on the planet, you know that something profound is happening beneath the surface of the global economy. But here is where the story gets truly extraordinary. This copper squeeze is not happening in isolation. It is happening on the same day that gold just set another all-time record above $4,800 per ounce. It is happening while silver hovers near its historic peak of $95 per ounce. It is happening as President Donald Trump takes the stage at Davos to deliver a speech that has European leaders questioning the very foundations of the Western Alliance. And it is happening while Japanese government bonds are experiencing their most violent sell-off in decades, sending yields on 40-year bonds above 4% for the first time in history. Every single one of these events is connected, and understanding that connection is the key to understanding where markets are headed next. Let me start with what happened in Davos today, because the geopolitical context is essential to understanding why metals are behaving the way they are. President Trump arrived in Switzerland by helicopter after Air Force One was forced to turn back due to an electrical issue. Even his transportation seemed to reflect the turbulence roiling global markets. And when he took the stage at the World Economic Forum, he delivered a speech that sent a clear message to America's closest allies. He is not backing down on Greenland. For those who have not been following this story closely, Trump has demanded that Denmark cede control of Greenland to the United States. He has threatened 8 European countries with tariffs starting at 10% in February and rising to 25% by June unless they support his acquisition of the Arctic island. European leaders have responded with outrage, and there is now serious talk of retaliatory measures that could include weaponizing Europe's massive holdings of American bonds and stocks. But here is the part of Trump's speech that made traders sit up and pay attention. He said he would not use military force to take Greenland. That sounds reassuring until you hear the next sentence. He said that if America did use force, it would be unstoppable. That is not the language of de-escalation. That is the language of a leader who is keeping all options on the table while offering just enough diplomatic cover to prevent an immediate crisis. The markets understood this perfectly. Gold surged to a fresh record because investors are pricing in the possibility that the Western alliance is fracturing in real time. Silver held near its all-time highs because the same safe haven demand that is lifting gold is flowing into the white metal. And copper is in chaos because the threat of tariffs and the possibility of a genuine trade war with Europe are distorting every supply chain on the planet. Think about what is happening right now in the copper market. American traders spent the past year shipping record volumes of copper into the United States in anticipation of tariffs. COMEX inventories in the U.S. have swelled to more than 500,000 metric tons, up from less than 100,000 tons just a year ago. That sounds like good news for American manufacturers. But here is the problem. All that copper that flowed into America had to come from somewhere, and that somewhere was the rest of the world. The London Metal Exchange is now experiencing the consequences of that massive transfer of metal. Readily available inventories on the LME have collapsed. Warehouses that were once full are now nearly empty. And the copper that remains is often spoken for, tied up in contracts or held by traders who have no intention of selling at current prices. The result is the squeeze we witness today. The result is a $100 spike in the COMEX spread that is signaling to the world that copper has become, quite literally, priceless in certain markets. Now let me take you to Japan, because what happened there in the past 48 hours is equally important and directly connected to the metals rally. Prime Minister Sanae Takaichi announced that she will dissolve parliament and call a snap election for February 8. That alone would have been market-moving news, but then she dropped a fiscal bombshell. She proposed suspending the 8% sales tax on food for 2 years. The cost of that measure is estimated at around 5 trillion yen per year, which is roughly $32 billion, and she offered no clear explanation of how the government would pay for it. The Japanese bond market responded with fury. The 40-year government bond yield rocketed above 4%, the highest level since that maturity was introduced in 2007, and the first time any Japanese sovereign yield has reached that level in more than 3 decades. The 10-year yield jumped above 2.3%, its highest since 1999. The moves were so violent that life insurers and hedge funds were forced to dump bonds to cover their losses, creating a self-reinforcing spiral of selling. This matters for metals because of something called the debasement trade. When investors lose faith in the fiscal health of major economies, they do not just sell bonds. They buy real assets. They buy gold, they buy silver, they buy anything that cannot be printed by a central bank or devalued by a government desperate to fund its spending promises. The Japanese bond meltdown is sending a message that the days of free money and infinite government spending are coming to an end, and the message is being received loud and clear in the precious metals markets. But the connections run even deeper. Japan's bond sell-off is spilling over into the U.S. Treasury market. American bond yields have been rising sharply as investors reassess the allure of holding American debt in a world where tariff threats are constant and the dollar's reserve currency status is being questioned. The 30-year Treasury yield jumped to nearly 5% today. That is a level that has not been seen in months, and it represents a significant increase in borrowing costs for the American government at exactly the moment when the national debt is already spiraling out of control. Here is the truly remarkable part. In a normal world, rising bond yields would crush gold prices. The traditional logic is simple. When bonds pay more interest, investors demand less of a return from gold, which pays nothing at all. Gold should be falling right now if the old rules still applied. Instead, gold just hit a record high above $4,800. Silver is holding near $95. The old rules are dead. The new reality is that investors are buying metals not despite rising yields, but because of them. They are buying metals because rising yields in Japan and the United States are symptoms of fiscal stress, not signs of economic health. They are buying metals because they understand that when governments can no longer borrow cheaply, they will find other ways to fund their spending. And those other ways almost always involve currency devaluation. Let me bring this back to copper and explain why the squeeze we saw today could be just the beginning. There are 3 separate entities on the London Metal Exchange that currently hold long positions equal to at least 30% of outstanding January contracts. If those positions are held to expiry, the holders would be entitled to more than 130,000 tons of copper. That is more copper than is readily available in the entire LME warehousing network right now. The math simply does not work. Something has to give. The traders on the other side of those positions, the shorts, are facing a nightmare scenario. They either need to find physical copper to deliver, which barely exists, or they need to pay whatever price is demanded to roll their positions forward. That is why the TOMEX spread exploded to $100. That is why we are seeing the most extreme backwardation in the copper market since the legendary squeeze of 2021. And that is why many analysts believe we are only in the early stages of what could become a historic supply crisis. Consider the forces at work. Copper mines around the world are struggling to increase production. Chile's Escondida mine, one of the largest on the planet, reported a 10% decline in output last quarter. Peru's copper production fell by more than 11% year-over-year in November. The Grasberg mine in Indonesia, the second largest copper mine in the world, remains partially closed after a fatal mudslide triggered a force majeure that is expected to last until at least the second quarter of this year. Supply is shrinking at exactly the moment when demand is exploding. And that demand is coming from sources that did not exist a few years ago. Data centers are consuming copper at a rate that has stunned even the most bullish analysts. Every artificial intelligence server, every hyperscale facility, every backup power system requires massive amounts of copper wiring and electrical infrastructure. JP Morgan estimates that data center installations alone will require nearly 500,000 tons of copper in 2026, an increase of more than 100,000 tons from the previous year. Electric vehicles continue to demand far more copper than traditional automobiles. Grid electrification projects in every major economy are racing to upgrade infrastructure that was designed for a fossil fuel world. And all of this is happening while the renewable energy transition accelerates, requiring copper for solar panels, wind turbines, and battery storage systems. The supply and demand picture for copper is as bullish as anything I have seen in my career. And yet copper prices are actually down slightly from their recent record highs. Why? Because the market is pricing in the possibility that a recession could crush demand before the supply crisis becomes acute. The Yangshan import premium, which measures Chinese appetite for copper, has halved over the past month to its lowest level since mid-2024. Chinese traders are telling us that at these prices, demand destruction is starting to occur. Manufacturers are finding alternatives. Projects are being delayed. The cure for high prices, as the old saying goes, is high prices. But here is what the pessimists are missing. The copper market can handle weak demand in the short term. What it cannot handle is the structural supply deficit that is baked into the next decade. Goldman Sachs expects LME copper to surpass $15,000 per ton by 2035. JP Morgan sees prices reaching $12,500 per ton by the middle of this year. Even the bears admit that the long-term picture is bullish. They just disagree about the timing. And timing matters more than ever right now, because the events of the past 24 hours have fundamentally changed the calculus for anyone thinking about wealth preservation, inflation hedging, and real estate investing. When Japanese bonds melt down and American yields spike, and European leaders threaten to weaponize their treasury holdings against the United States, the traditional playbook no longer applies. Diversification is no longer optional. Let me talk about silver for a moment, because the white metal is in many ways the most interesting story in the precious metals complex right now. Silver set an all-time high of $95.87 per ounce just yesterday. That shattered the previous record from 1980 that had stood for more than 4 decades. And yet, silver remains dramatically undervalued relative to gold if you look at historical ratios. The gold-to-silver ratio is currently around 50 to 1. That means it takes 50 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 40 to 1. And during periods of extreme precious metals enthusiasm, it has dropped to 20 or even 15 to 1. If gold reaches $5,000, which many analysts now consider a realistic target, and the ratio drops to its historical average, silver would be trading at $125 per ounce. If the ratio drops to where it was during the Hutt Brothers era in 1980, silver would be approaching $250 per ounce. Those are staggering numbers, and they explain why retail investors in China, India, and the Middle East are fueling what analysts are calling a global squeeze in the physical silver market. Silver has something that gold does not. It is an industrial metal as well as a precious metal. More than half of silver demand comes from industrial applications, including photovoltaics for solar panels, electronics, and medical devices. This dual role means that silver benefits from both safe haven demand when markets are fearful and industrial demand when economies are growing. It is a rare asset that wins in almost every scenario except a severe deflation. And right now, deflation is the last thing anyone is worried about. The silver market has now experienced 4 consecutive years of global deficits. That means demand has exceeded supply for 48 straight months, and those deficits are deepening, not shrinking. The world is consuming silver faster than it can produce it, and the stockpiles that once provided a cushion are being drawn down to dangerously low levels. The physical silver squeeze that began in late 2024 is intensifying. Lease rates have soared, premiums for physical delivery have exploded, and the paper promises that once satisfied demand are increasingly being tested against the reality of empty vaults. If you are thinking about retirement planning and wondering whether precious metals should play a role in your portfolio, this is the moment to pay attention. The traditional 60-40 portfolio of stocks and bonds has delivered negative real returns for years now when you account for inflation. Real estate investing faces headwinds from rising mortgage rates and demographic shifts. Cryptocurrency remains too volatile for most conservative investors. Precious metals, particularly gold and silver, offer something that few other assets can provide: a thousands-year track record of preserving wealth through wars, famines, currency collapses, and political upheavals. But I need to be clear about something. I am not telling you what to buy or when to buy it. That would be inappropriate and potentially harmful given that every investor's situation is unique. What I am telling you is that the signals emanating from global commodity markets right now are unlike anything we have seen in at least 5 years. The copper squeeze is real. The silver deficit is deepening. The gold rally is accelerating, and the geopolitical backdrop, from Greenland to Japan to the potential fracturing of the Western Alliance, is creating conditions that favor hard assets over paper promises. There are options to consider for those who want exposure to these trends without taking on excessive risk. Silver and gold ETFs offer liquid, cost-effective ways to gain exposure without the hassles of physical storage. Mining stocks provide leverage to rising metals prices, though they come with operational and jurisdictional risks. Physical bullion remains the purest form of wealth preservation, though premiums are elevated and liquidity can be an issue for large holders. And for those focused on retirement planning, precious metals IRAs allow you to hold physical gold and silver in a tax-advantaged account, though the metal must meet purity standards and be stored with an approved custodian. Let me circle back to the copper squeeze and explain what could happen next. The LME has rules designed to prevent squeezes from spiraling out of control. Large holders of long positions can be forced to lend their metal back to the market at capped rates. Emergency interventions are possible if the exchange determines that orderly trading is threatened. But those rules were put in place after the 2021 squeeze, and the market is already testing their limits. The spike to $100 in the COMEX spread suggests that the rules may not be sufficient to contain the forces at work. There is also the question of what happens if copper flows start reversing. For the past year, metal has been moving from the LME to American warehouses in anticipation of tariffs. But the recent spike in LME spot prices has actually pushed American futures into a discount. That means the arbitrage trade that was draining copper from London is no longer attractive. Small deliveries of copper are already appearing in previously empty LME warehouses in New Orleans. If that trickle becomes a flood, it could ease the squeeze and bring prices down from current levels. But ease is relative. Even if the acute phase of this squeeze passes, the structural supply shortage will remain. Copper projects take years to develop. The mines that were not built in the 2020s will not magically appear in the 2030s. And the electrification of the global economy will proceed regardless of what happens to prices in the short term. Governments have committed trillions of dollars to renewable energy and grid modernization. Those commitments require copper. And right now, there is not enough copper in the world to meet them all. The broader message here is about liquidity crisis and what happens when multiple asset classes experience stress simultaneously. We are watching Japanese government bonds collapse, while American treasuries sell off, while European leaders threaten financial warfare, while copper squeezes and gold surges, and silver holds near records. These are not isolated events. They are symptoms of a global financial system that has been running on borrowed money and borrowed time for far too long. The fiscal policy mistakes of the past 2 decades are coming home to roost. Japan printed money to finance its government for a generation and is now facing the consequences as inflation finally forces rates higher. The United States has added trillions to its national debt and is now discovering that the treasury market is not infinitely elastic. Europe has relied on American security guarantees while building an economy dependent on cheap Russian gas and Chinese exports, and is now realizing that both pillars are crumbling. In this environment, hard assets matter, commodities matter, copper matters, silver matters, gold matters. They matter because they cannot be printed. They matter because they have intrinsic value. They matter because when the confidence that underpins paper currencies begins to erode, physical metals provide something that nothing else can, a store of value that does not depend on any government's promise to pay. I want to leave you with one final thought. The events of the past 24 hours have been extraordinary, but they are not unprecedented. Markets have experienced copper squeezes before. Gold has set records before. Governments have faced fiscal crises before. What is different this time is the confluence of forces, the simultaneous pressure on multiple fronts. the sense that the system is being stressed in ways that it was not designed to handle. Those who are prepared will navigate this period successfully. Those who understand the signals will be able to protect their wealth and potentially prosper. Those who ignore what is happening in commodity markets, who dismiss the copper squeeze as a technical curiosity, who assume that gold and silver are just speculative bubbles, may find themselves caught off guard when the next phase of this crisis arrives. The $100 copper spread was a warning shot. Thank you for watching. Make sure you subscribe and turn on notifications so you never miss a market update. I will see you in the next video where we will dive deeper into what the Greenland crisis means for the dollar and why European leaders are seriously considering using their treasury holdings as a weapon against the United States. Until then, stay informed, stay prepared, and remember that in uncertain times, knowledge is the ultimate safe haven asset.